Hi everyone, welcome to the channel. Today we're going to be looking at the company Advanced Auto Parts, ticker AAP, which operates a network of retail stores offering a wide range of automotive parts, accessories, and maintenance products. This company has recently hit a rough patch with the stock dropping about 70% over the past year, and they recently brought in a new CEO to help turn things around. So we will look at the company's financials, perform a stock valuation, and at the end of the video, we'll go into computer modeling to forecast the 52-week stock movement. But first, this is a company that I do own, so we will look at my recent purchases. So let's jump right into it. So Advanced Auto Parts is my most recent stock investment, and we can see here I purchased into the company last week on Friday, October 13th. And this is a smaller investment for me as I do have some concerns with the company, and we'll discuss that a little bit more when we get into their financials. But I do feel that the market has oversold AAP, and I'm optimistic it can make a profitable recovery. But since buying into it, we can see here my investment has gone up almost 8%, while the S&P is up about 1%. Now, this was something I was not expecting the stock to jump as much as it did in such a short period of time. But looking a little below, we can actually see the investment here. So my investment is about $3,500 and up about 8%. It's only a couple $100 gain, so just under $300 in profit so far. So that is my investment. So now let's just jump over into the financials and take a look at that. So here we have their financials, and just to make a note, their far right hand column, this is actually based on their trailing 12 months. That's because the past two quarters in 2023, Q1 and Q2, have been pretty negative for the company. And one of the reasons why they've cut their dividend, which is a pretty big factor for me. And in general, when a company cuts the dividend, it's not a good sign. And we can see here they've cut it probably about in the 20-25% range. But also, we can see net income has actually been down over the previous 2 years, and same with earnings per share, and down almost 50% from 2020. So these are two of the big metrics that are bringing the stock down as much as it has been over the past year. I believe I mentioned earlier it's down about 70%. And we can also see book value is down over the past 2 years. Same thing with free cash flow, with this most recent trailing 12 months being negative. The only positive signs here is the revenue. We can see over the past 6 years it's been growing, and also the share count. It looks like it's declined from about 73.4 million in 2013 to most recently just over 60 million shares. But I do not expect any additional share buybacks, at least in the near term, until they fix some of their financials. And if you are going to be interested in investing in Advanced Auto Parts, I will link to a good article from Seeking Alpha. They go into a lot of in-depth details on some of these negative data points that they had recently and some of the concerns you might want to consider moving forward. One of the things they do suggest is waiting for their Q3 results. That'll be the first time their new CEO will be in charge, and he may lower expectations just to give himself a better footing to start off on. So, I highly suggest you reading that if you are going to consider taking a position in AAP. And this is one of the reasons why I only took a very small position in the company. And moving a little lower to look at net profit margin, I usually like seeing a company in the 10% range, and we can see here they're quite lower in that 5% range. So again, another one of those concerns. And then also return on equity. Uh, Advanced Auto Parts is in the specialty retail industry, which typically averages around 24%, though auto parts are in the 7% range. So if we take the average for this type of company, that would be about 15.5%. And we can see there, they're typically in that range, in that 15 to 20% range, though I know the past trailing 12 months, slightly lower, just under 13%. But let's scroll down a little bit lower and we'll look at some more data points on a graph. It's a little easier to see. Here in the graph, look at the first one in white, the revenue per share. We can see it has grown over the past 10 years. A lot has to do with those share buybacks. As we can see over the past year, they have not reduced the share count, so it was pretty flat. But we can see in the middle there, it had that nice run up. And then moving on in red, book value per share. Same thing, it has been going up, but most recently, book value has gone down. And we can see that small drop off here as well. Free cash flow per share and earnings per share, because of the access, is not as easy to see. And I know earnings per share has been relatively flat. Yes, it has gone up, and most recently it has gone down, but still it hasn't gone up that much. And then for free cash flow per share, that has gone up a little bit more. But again, we mentioned that trailing 12 months, it's negative. So you can see here dropping below zero. And then dividends, we spoke about that. It was increasing, but most recently they've have cut that dividend. And then looking at the other two data points in terms of percentage, return on equity, we can see that has dropped off from about 10 years ago, where it was averaging more in that 20% range. It has been a little underneath 15% at times. And over the past 3 years, it was over 15%, except for this trailing 12 months. And same thing with net profit margin. We already spoke about that. It's typically around 5%. But ideally, we want to see that around 10%. So let's move on from the chart and we'll actually look at the valuation of the stock. So evaluating the stock, you can see I previously did this back in March of this year. This was right before they released their Q1 results. So before that, I was showing them at $106 for intrinsic value, and with a margin of safety of 65%, that brought it down to about $69. And I was using a 5.4% short-term growth rate over 7.5 years. After that, it would be 3% growth rate, and actually using a higher discount rate of 12%. Typically, I've been using 10%, so I was using a little bit higher, being a little more conservative. But now, based on the trailing 12 months, so taking into account Q1 and Q2 of this year, intrinsic value has dropped down to just under $83. And same thing with a 65% margin of safety. That comes out to just under $54. So if you remember a few minutes ago, I purchased it around $50 or so. And I believe right now it's trading around $54 at the close of October 17th. So again, slightly up about 8% and currently above what my margin of safety intrinsic value is. And with that, because of their recent financials, I have dropped their short-term growth rate to 3%. So that would be matching their long-term growth rate of 3%. And same thing, using a 12% discount rate. Looking at some other metrics here. So return on invested capital. I really like seeing companies over 10%. We could see over the past 10 years, yes, they achieved that, but most recently more in the 8% range. So again, they've been going through some struggles. So in that 8 to 9%, not too bad based on their current situations, but I know the current situation is really based on the most recent 12 months. Book value, unfortunately, that's been dropping as we noticed when we looked at the financials above. Same thing, earnings per share haven't been doing so great on that. And sales, yes, sales have been going up, just not as much as I would like to see in that 10% range over these time periods. So again, some of my concerns and reason why I'm only investing a small amount of money. And we'll go down a little lower to look at some other data points. And the first one is the PE ratio. So you can see 9.47. So for a value investor, that's a nice opportunity. However, they do have some concerns as we discussed. So this may be a value trap, but again, I'm staying a little more optimistic, hoping the new CEO can help turn things around. New CEO is coming over from Home Depot, a great company with a great track record, especially over the past 10 years. So hopefully he can bring some of those achievements he had over at Home Depot here to Advance Auto Parts. Long-term debt to free cash flow, because the trailing 12 months is negative, is kind of throwing that off. Over the dividends, so we did see that dividends have been increasing over the past 10 years, though most recently they have cut that dividend. So this is down somewhat than what it would normally have been. Share count, we saw share count's been declining over the past 10 years. So just over 17% actually, but I do not foresee share counts to go down. At least anything significant over the next year or two, and hopefully it does not go up. That would be more of a concern, and probably when I know I'm definitely not going to hold on to the stock. And again, we looked at the net profit margins, and it's typically been about 5%. And for the past 10 and 3 years, it's been right at that 5%. So now let's move on and look at the computer modeling to see what that is forecasting for the next 52 weeks. In the computer modeling software, I already ran the analysis using two methods. First is the M5 rule shown here. The other would be random forest, which we'll look at in a little bit. But this most recent Monday, October 16th, in the far right-hand column, the stock price closed at $53.59, and the column right next to it is the S&P 500 ETF, which closed at 436. The other columns is just some various data points for advanced auto parts. I did take all these results and have pasted them into Excel, so we'll look at that a little more closely. So right now I'm just going to scan through and take a look at what the forecast is looking like. And it is showing a uptick in the stock price going out into early next year, but then dropping off and actually falling below from where we are today, and actually from where I purchased in at around $50, but then closing out the 52 weeks at $51.56. So let's jump over the random forest method, and we'll just take a quick look at that before we move on to analyzing everything in Excel. And same thing, this most recent Monday, October 16th, the stock price closed at $53.59. And as I scroll down, what I'm seeing is more of a bullish run on this stock using random forests, and actually closing out the 52 weeks at $75.37. Typically, when I do these forecasts, the M5 rule is more of the bullish, while random forest is more bearish. So this is a little unique when it's the reverse. But let's look at this data in Excel. It's a little easier to see and graph. Back in Excel, I already graphed all the data we got from the computer modeling. And first, this vertical red line that represents this most recent Monday, October 16th. So everything to the left is the historical stock price for advanced auto parts in blue, and everything to the right of that vertical red line is the forecasted stock price. But just looking at some historical movement in the stock, we can see from 2009 up until about October of 2015, it had this nice run going from just below $50, hitting around $200, and then kind of dropping off over the next couple of years, going below 100, then ticking back up, then going back down in 2020, probably due to COVID, going back under 100, and then having a nice run up into 2021, almost hitting $250. But since then, we can see this strong decline it's had, and actually falling to a price that it hasn't seen since about 2011. So it's at a very low price based on its most recent historicals over the last 10 years or so. But let's move over and we'll take a little closer look now on the projections that we just did using the two methods, and then also taking the average. First, we're looking at the M5 rule, and same thing with that vertical red line. We're going to look at everything to the right, so that would be the forecast. And as we saw in the computer modeling software, it had the initial uptick. If I recall, it got into the $60 range, which would be about a 12 to 13% return. However, in next year, it had that decline, as we're seeing here, falling below $50, getting into a $40 range, but eventually going back up and closing at around $51 out in October of next year. So from this past October 16th, going out 52 weeks, that would be a slight negative return, just under minus 4% with the M5 rule. But let's go over, look at random forest next. That was a little more bullish. Random Forest also had that nice run up going into next year, and from here it's looking like it's getting to close to a 80 to $90 range, which would be more, about a 70% return on the stock. However, then dropping off later next year and closing out the 52 weeks in October of next year at around $75 would still, it would be about a 40% return if this does pan out. A little bit more on the a bull run. I think the next quarterly results with the new CEO is really going to dictate what direction or which one's more likely to come to fruition, random forest or the M5 rule. But let's also look at the average just to take that into account as well. Looking at the average, obviously, it's taking the M5 and random forest into account. And since both of those had the initial uptick, we're seeing that here. And for an average, looking like it's getting in that $70 range, which would be an over a 30% return. However, dropping off similar to how we saw in both of the other methods, and actually closing out the 52 weeks at around $64, which would be in an 18 to 19% return, which still would be nice for a 1 year return to get that type of results. In conclusion, though I did buy into the stock, I still believe it is slightly risky, and the new CEO needs to prove that he can turn things around. And the next quarterly results will play a big part into the coming year, as it will be his first earnings call. And the company has to show that it can improve on these key data points, such as revenue, earnings per share, free cash flow, and of course, eventually getting back to increasing their dividend. But as we saw, this company has seen multiple run-ups in the stock price, reaching two and even close to $250 per share. And this is a well-known brand in the automotive repair or automotive retail industry. So being optimistic, I do think there's a good possibility that they can see these higher stock prices in the coming years if things go the right way and the new CEO can turn things around, as I'm sure he's planning to do. I hope you enjoyed the video and consider subscribing, and I'll see you next time. Thanks.